Companies that feel their shares are trading at too high a level can decide to issue new shares so that the share price actually trades at a much lower level, so that it becomes easier for ordinary investors to take a position in that particular stock. This is what Netflix has decided to do, cutting its stock price in a 7-for-1 stock split from around $700 to around $100 a share. Well, for the company, it increases the number of shares available, so that increases liquidity, makes it more easier to trade, both for individual investors and for institutions. And for investors themselves, particularly ordinary retail investors, it makes it easier to actually take a position in that company. For example, when Apple was trading at around $680 a share, the shares became rather expensive. In your individual portfolio, you'd have to allocate a large amount of funds for each position. And so by cutting that, it means you can still invest in a company like Apple, but without committing such a large amount of capital. For an investor, if you look at the data over the past sort of 30 years, actually companies that carried out stock splits do tend to outperform the market in the next sort of 2 or 3 years. Indeed, there are some funds in the US that choose to invest purely in companies that have undertaken stock splits, and they have outperformed the broader market by around 7 percentage points each year over the past 5 years. So for an IG client, if you had a spread bet position in Netflix at the moment, your position will be adjusted so that instead of trading at around $700, it trades at $100, and your profit and loss will be the same amount, but your position will be divided by 7, so that you have the same exposure to the company. If you have a CFD position, so for example if you had one CFD contract in Netflix trading at the current level, after the stock split you will then have 7 contracts at the new level. So your exposure overall remains the same, as does your profit or loss.